Welcome, everyone, to our next webinar for Thrive in 25, Unlock Passive Real Estate Investing with Westcliff Asset Management. Today, we're really excited to have a special guest, a good friend of mine, Matt Spoke from Toronto Standard, who's going to talk quite a bit about missing middle housing. And so we're looking forward to diving into that today. We'll start with an introduction to Westcliff, talk a little bit about learning more about Matt Spoke, and then we'll dive right into some of the projects they have on the go. I'm joined today by my trusted co-host and partner here, Addy Saeed, a veteran in the real estate industry. He's done a lot of acquisitions, worked for some of the largest investment funds here in Canada. He's a registered dealing rep with Waverley. And then myself, Kaz, I'm a 20-year veteran in finance. Most of my career has been in real estate. I also am a registered dealing rep with Waverley. As far as Westcliff Asset Management and what we do as a firm, there's three main pillars or part of our ethos. The number one is around helping people learn. And that's really focusing in on education around real estate investment opportunities. You can learn more about what we do in terms of learn at win.westcliffam.com. As far as investing, we like to look at different projects where we co-invest or even bring opportunities to the table. Again, you can learn more about that on our website. And then finally, on the manage, we offer full asset management services to our clients, whether it's passive or active projects, where we help our clients everything from property management right through to their day-to-day accounting needs. So really, you can invest in a project and we can help you make that come to life and as pain-free as possible. So let's dive right in. We've got Matt Spoke here from Toronto Standard. Got a nice headshot there. Picture looks just like him. But Matt, why don't you welcome yourself to the listeners and tell us a bit about yourself?
Yeah, thanks for having me, Kaz and Addy. So as you said, I'm a partner at a small Toronto development business called Toronto Standard, a business that I started along with two partners just about 2 years ago, focused on, broadly speaking, missing middle housing in Toronto. I think the definition of that term we can get into, it's been extended a little bit. We used to build multiplexes. Now we're building sort of like small mid-rise apartment buildings. We exclusively build in Toronto for long-term ownership. We're focused on the purpose-built rental market, and I'm sure there's a lot of trends that we'll get into that sort of paint the picture of the opportunity in that space. One, very bullish on the city. You know, naturally, there's always things that we can complain about when we look at the politics and regulatory environment of places like Toronto. But at the end of the day, this is a place where people want to live and capital wants to be and jobs get created. And so, you know, long term, we continue to be very bullish on the prospects of the city of Toronto. And if you can navigate the complex web of how to get housing built and how to do it at a price point that makes sense, then you're holding on to a great asset in a great location. So that's sort of our general ethos. It's pretty straightforward, but I'm sure we can get into more of the details as we have this conversation, but happy to be here.
Matt, do you want to give us a little bit of a background on how you got to Toronto Standard? What did you do before, and what was your career path like?
Yeah, so my background's a little bit unusual in the sense that I'm relatively new to the real estate market. I've been in this business about 2 years, and that's effectively the length of my real estate experience. But my two partners bring, I'll say, more of the traditional real estate background to the table. One partner, my brother Chris, who has for a number of years been in the development management world, managing large-scale high-rise and mid-rise developments in his prior role for a condominium and rental developer. In that role, having spent a lot of time sort of managing the dynamics with the city, specifically on rezonings, on site plan approvals, on effectively everything from acquiring land to getting building permits issued for construction. My other partner, Chris, two Chris's in the business, has been a 20-year-long residential broker, but also over the course of the last 10 years, started building his own portfolio of multiplexes before the popularity of multiplexes really picked up and the policy really shifted. So got very firsthand experience, mostly in the West End of Toronto, where we're all sort of like originating from the High Park, Runnymede, Bloor West Village area of Toronto. So just because of that familiarity, a lot of our projects historically have been geared towards the West End. But Chris has spent years now building and managing a portfolio of multiplexes, everything from 3 plexes up to 8 plexes. And then myself, my background before this was in tech. I started 2 software companies over the last 10 years. And in that capacity, spent a lot of my time sort of on the capital side of those businesses, raising both equity and debt, structuring businesses. So that's what I bring to the table in this context. I spend a lot of my time talking to equity groups and lenders and sort of structuring deals. So between the 3 of us, we sort of cover all of our bases. We also brought on recently a new construction manager onto our team that we can talk about in what capacity we're building our own projects, in what capacity we work with third parties. And we have an accounting manager on our team as well. So there's 5 of us at Toronto Standard, all inclusive.
Excellent. Why don't we move into the next slide? So we wanted to talk a little bit about missing middle housing, or maybe help define that for our listeners, because again, as you said, the definition has stretched quite a bit. And also we were talking about earlier, just in our general chat, about how your firm is quite active on trying to, I would say, influence and partner with government to try and drive creating more housing. So talk a little bit about some of those topics, and let's just have an open conversation about it.
Yeah, this is something that is like really a constantly changing topic. Zoning is an ever evolving thing in the city of Toronto in a positive way. When we started this business, it was on the back of policy changes that were being proposed at city council that were effectively going to unlock a new product type in the city. But missing middle, just to start there, is this label that has become commonly used across North America to define any type of housing product that is maybe more dense than a semi-detached or a townhouse, but less dense than like a high-rise condominium or apartment building. In that middle category, you'd have everything from like small walk-up apartment buildings that might be 3 or 4 stories, 6 to 10 units, the type of thing that you would commonly find in older American cities like New York and Philadelphia and Boston. You'd have small mid-rise buildings, maybe 6 to 8 stories, single elevator. You'd have multiplexes, single structures that are in fact multifamily dwellings, like a 4-plex or a 6-plex, that are only more recently being permitted in the city of Toronto, with some caveats that we can dive into. So it really is a sort of like all-encompassing term for Toronto and really the greater GTA. Over the course of the last 10 to 20 years, has really built 2 products. We've built high-rise and we've built subdivisions, right? And on the subdivision side, it's what you think of when you think about the suburban sprawl around the city. Places like Milton that have exploded, places like Vaughan, King City, et cetera, out in Durham region, where you're just building lots of single-family homes in what would previously have been farmland for the most part. And then in the cores of the cities, we built massive high-rise towers, right? We built entire neighborhoods of high-rises, places like City Place when that was built 20 years ago, and then other sort of like dense pockets around Yonge and Eglinton. And in my neck of the woods in Etobicoke, you've got Park Lawn, where 15 towers got built over the course of 10 years. But we never really built much in the middle. And for the most part, it's not because the market wasn't interested or demanding, alternatives to a 40th story of a glass tower or living in the exurbs of Brampton. It was mostly that zoning policy did not permit these things. Zoning was very restrictive in terms of like land use permissions. And so we're guided in Toronto, and as in every municipality in Canada, by documents called the official plan and the zoning bylaws. And the official plan effectively dictates what we're allowed to build where. In some cases, that's as simple as like, can you build residential or commercial or industrial? But if you're building in a residential zone, what type of residential are you permitted to build? Is it detached single family homes? Is it small apartment buildings? Is it semi-detached? And there's all these sort of zoning restrictions that sort of make it difficult to build certain things. And over the course of the last few years, missing middle housing started to become an area that the city was open to exploring as the next horizon of development in the city. And this is actually dates back to before the high-rise condominium market started to slow down. Like some of these policies started getting introduced at the city when John Tory was still mayor, under what he called his housing action plan, when Brad Bradford at the time was chair of the Housing and Planning Committee. They started introducing policies around 4-plexes just to allow for what we've come to call gentle density in neighborhoods. One of the underlying theses behind this type of housing is that these neighborhoods that we've built over the course of the last 50 years in places like Toronto or 100 years, they're already serviced. The infrastructure already exists. The schools are already there. The parks are already there. But in many cases, the populations of these neighborhoods have actually reduced over time. And the reason is because like what might have been a house that housed a family of 5 30 years ago is often now a house that just has a retired couple in it and no kids, right? And so you see the population of streets going down. We've seen neighborhoods in Toronto where elementary schools are on the verge of shutting down, even though in the suburbs we actually need more schools, but in the core we're shutting schools down. Like all of these things that have sort of pointed to a problem that, one, we need to increase density in certain parts of the city. And 2, the single family homes that exist there are too expensive for like new entrants into the market, young families, young couples, right? That sort of pushed the city to consider small zoning reforms. And that's been this constant evolution over the last 3 years that we can get through, because it sort of feels like every 3 months now there's new policy changing that's encouraging more of this. And it started with multiplexes, then it went on to the laneway suites and garden suites, then it went on to major street apartment buildings. And there's a whole bunch of nuance in there that I'm sure we can unpack. But that's the general context of missing middle housing that we're really focused on as a business.
So a couple of questions. How is land cost affecting what is being built right now in the city? Because obviously everybody that is doing a pro forma, they're looking at getting the highest and best use, and highest usually means the tallest and getting the most density possible and generating the most return. And then from what you're defining and telling about missing middle, what you're looking at is smaller neighborhoods that are being converted into higher density. So land cost is one, and second is how are you dealing with NIMBYism, not in my backyard. I would imagine there's probably a lot of that you're seeing right now in opposition of these developments.
Yeah, the land cost question is a good one. It really depends on like where we are on the spectrum of missing middle. Like I'll say we do a lot less multiplex today. We're doing more sort of small apartment buildings, like 6-story, 7-story apartment buildings that are still considered small in the context of like Toronto real estate over the last several decades. And so how we think about land in those two contexts is slightly different. But I'll say the obvious starting point is that when you're buying a piece of land, often a single family lot, a house, there's two ways to think about the value of that house. There's, what is existing use? Is it a nice house that people want to live in? Or is it a rundown, abandoned, decrepit building that's boarded up, right? So if it's a nice house that people want to live in, often the highest value of that house is actually going to be to somebody who just wants to buy it and occupy it, right? If it's a decrepit, abandoned piece of land that used to be a house or is boarded up, then often the highest value is actually somebody rebuilding, whether they're rebuilding a new home, a new custom home, or rebuilding something like a multiplex, a fourplex or a sixplex or something in that category. So who you're competing against in the land market really depends on what it is that you're buying. Very right out of the gate, we will never look at land that has a nice structure on it. It's often priced for its end use, and it's not priced for development, right? So it's too expensive. If there's a nice house sitting on it, or even the nice bones of a house that could just be renovated into a nice house, that's often enough for the price to get pushed outside of the band that makes sense for our pro formas to make it sort of add up. So we're quite strictly looking at houses that are on their last legs or properties where the previous structure has already been demolished. So that could be a house that's been unoccupied for several years, sitting in an estate or gone through a foreclosure or something along those lines. We have 2 houses on Kipling Avenue as an example that we're developing right now. Both of them are boarded up. Both of them have been vacant for over 10 years. And so in that context, the best use is actually to demolish and rebuild. And so we were able to get those at effectively the face value of the land without paying for the house because the house was worthless, right? And if it's a nice house, often there's value in the house. If it's a decrepit house, often the house represents a liability because you really have to pay to demolish it. So it's almost like there's an additional cost to having a house on the structure. And so I'll say when people are building multiplexes, you're often seeing them buying very rundown pre-existing structures that maybe haven't been renovated in 50 plus years. The buyer is either going to put $1 million into building something new or renovating substantially, or the buyer's going to tear it down and build a multiplex. The multiplex business, there's some variation to this. I've seen people pay everywhere from $800,000 for a standard Toronto lot, let's say a 25 by 120 foot lot or 130 foot lot, up to maybe $1.2, $1.3 million, depending on the neighborhood. It's often a factor of what rents do you think you can sort of generate in the neighborhood where you're building. In our business on the small mid-rise, and in our context, that usually means like 30 to 60 unit buildings that we're developing. We're generally paying somewhere in the range of $60 to $80 per square foot, which translated to a land value is often around $2.5 to $3 million for a lot that would be big enough to support 50 or 60 unit building, which in most cases means 2 lots, 2 lots together or a big sort of like uniquely oversized lot. Kipling, we have 2 lots. We paid 1.2 for each lot. And then so combined, we have 2.4 million for our land price. But it's Etobicoke, so the lots are large. We have 44 feet per lot. We get 88 feet of frontage across 2 properties instead of like a more of a core Toronto house might only have 25 feet per lot. We get 44. It is very rent dependent on the land side, and that is very neighborhood dependent. So if you're in an area where you think you can drive rents, call it above $4 a square foot, it leads to a very different set of calculations than below that threshold.
So you're all obviously doing assemblies as well when you're doing these. Have you come across doing multiple, like assembling multiple lots? Because you have two right now. Have you done two or three or four or more? Or are you just seeing like two is usually the number?
Yeah, we're even trying as often as possible to avoid assembly at all. I mean, and that often points us towards like single oversized lots, if possible. The problem with assembly is that the reality is more often than not, there's a single lot that's listed. Let's say an old house that gets put on MLS and we might be able to buy it at a good price. But now I have to go convince a neighbor who doesn't want to sell, and that means I have to pay a premium for that neighbor. And that premium might be too much for what the pro forma supports. So unless you're really fortunate and there's two neighboring houses that just so happen to go to the market right around the same time or have previously been assembled, the two houses we bought on Kipling, we bought off of a developer who had assembled them 5 years prior to us, thought he was going to build townhouses, sort of lost his shirt when interest rates went through the roof and had no choice but to sell. So we bought an already assembled like 2-lot site. We have another site on Dufferin. It's a single lot, but it's just a large single lot. That's generally easier for the model because to convince, we've done a lot of high-rise assembly in the past, like as a business, where we would buy 5, 6, 7 houses in a row and then flip them to a high-rise developer for a tower. In that context, there used to be enough value in these high-rise towers that you could pay like a real premium for land when you're assembling, right? So if the house is worth $1 million, you can go and offer everybody $2 million to move out of their house because that was worth it in the pro forma of, let's say, a condominium development. But when you're doing something smaller like we are, you don't have that amount of premium to pay on the land. So you're trying to get these properties for like as close to just market value as possible. And often we're the only bidder because it's sort of not obvious what you would do with the lot, if not what we're doing, right? It's becoming more common, but like when we started this business, there wasn't a lot of people looking to build 30, 40 unit apartment buildings in Toronto.
And how are you dealing with the neighbors? Because obviously, if it's an eyesore, I can see that it will be an attraction for the neighbors to get rid of that eyesore.
Yeah.
But bringing more density in a lot of times comes with a lot of objections. What kind of expressions are you getting from neighbors, and how are you dealing with the feedback that you're collecting?
I mean, there's a lot of different context that depends on the policy we're relying on. So let's start with multiplexes. Multiplexes, in theory, within certain parameters, you could build as of right, and you actually don't even need to seek input from your neighbors. The moment you need to seek input from your neighbors is the moment you're trying to go outside of the policy. So if you're trying to go to the committee of adjustments for variances from the policy, for example, you might want the building to be a little bit taller, you might want to make it a little bit wider, whatever the variance is that you're seeking. Then all of a sudden you open yourself up to input from the community, right? And that can be, depending on the neighborhood, very, very hostile and aggressive. But if you want to just build exactly what the policy prescribes, you can go straight to building permit for these types of things, right? The avenues for your neighbors to oppose you are pretty limited. I mean, it used to be, we built a sixplex we bought the land maybe 2.5 years ago. And at the time, we went through committee of adjustments. It was on, what today is called a major street, but at the time it wasn't, a street called Annette Street in the west end of Toronto. And at the time we had a good committee, and committee approved our variances, but there was still the ability for third parties to appeal decisions made by the committee of adjustments. And so we had a neighbor appeal us, and we had to effectively negotiate with this neighbor to make the appeal go away. And what ultimately happened after that is the policy changed. The provincial government started to disallow third-party appeals. So the moment committee decided, neighbors no longer had an avenue for appeal, like that right was taken away. And so I think that's been a positive change in the sense that neighborhood opposition can be extremely can be challenging for projects just from like the perspective of uncertainty. If you're really buying land, you need to know that there's a good path towards what you're trying to accomplish. If there's any amount of uncertainty, it's often too much risk to put money into land. So that's been a positive change on policy.
So the real estate market has been really frothy for the past 20 years, and the for sale market has generated quite a lot of towers in our landscape. It's changed our landscape completely. And one of the offsets, one of the benefits to the city has been development charges that they've been able to collect, and their constant appetite of increasing their development charges as well. So can you walk us through like what sort of costs are you anticipating anytime you're doing these missing middle projects? How much are you spending on taxes? Is it a hindrance? Is there any relief available if you're building missing middle projects? Like, how can the city step up and how can builders build more of these projects?
Well, I think you framed it correctly in the sense that development charges were this very convenient and hidden way for the municipal governments to generate tax revenue when nobody really noticed because values kept increasing year over year, right? So it was one of these taxes that nobody really minded paying just because if you bought a condo for $1,100 a square foot and you knew you could assign it at completion for $1,400 a square foot, you didn't really care that the city was charging you 50 grand or 80 grand in development charge because you made so much money on that assignment. The moment the market plateaued and in many cases started to decline, I think the impact of those taxes became a lot more obvious. And the biggest one when we talk about taxes and development is development charges that are levied by the municipality. Development charges are a one-time, historically upfront payment before the building permit is issued based on the type of unit you're building. So if it's a condominium unit versus a rental unit, there's different rates. If it's a single family home versus a multifamily dwelling, there's different rates. But generally, you're paying a rate based on the number of units you're developing and the size of those units. So they all 1 bedrooms, 2 bedrooms, 3 bedrooms, whatever the case might be. And that was always an upfront payment before they would issue your building permit, which meant you needed to fund that out of your equity check, right? So let's say in a small development, let's say 10 units for the sake of easy math, an average development charge in a 10-unit multifamily dwelling could be about $50,000 per unit. And so on 10 units, you might have to write a $500,000 check to the city before they'll issue your building permit. Naturally, on a 10-unit development, $500,000 is a very significant cost. And not only is it a significant cost to the project, it has to be funded out of your equity because you haven't yet rolled into your construction financing, right? One thing that the city did, which I think was a positive change as they started realizing that development charges were having a very adverse effect, is they allowed for the deferral of development charge payments so that instead of paying it ahead of building permit, you could defer the payment to the end of your development before occupancy permits, right? And what that allowed you to do is effectively not pay for the development charge out of your equity, but pay for it out of your debt. And that really made the math on the equity side of the equation quite a bit better. That said, they fumbled that policy as you'd expect. I mean, they threw a pretty expensive interest rate on that deferral so that in the process of deferring, you'd have to pay interest to the city, et cetera. Ultimately, I think where this is shaking out is both at all levels of government, federal, provincial, municipal, there's become a realization that development charges are a massive hindrance to housing development. And we heard this out of Mark Carney in the last federal election. We've had mixed feelings about Doug Ford, but he's starting to talk about this. And then naturally, Olivia Chow is starting to make moves on this as well. Most recently, in cities outside of Toronto, that started to show up in development charge reductions across the board. So cities like Vaughan have now reduced their development charges by 50%. Mississauga has reduced its development charges by 50%. And in fact, on 3-bedroom units has eliminated development charges altogether to encourage more development of 3-bedroom units. Toronto has not gone that far, although we think it's possible that they might. But very recently, they created an exemption for buildings up to 6 units. So in this context, call it a sixplex, to effectively have no development charges for sixplexes or anything smaller than a sixplex. So if you're building a 4-plex or a 5-plex or a 6-plex, there is now a development charge exemption. That exemption does not carry into larger developments. So if you're building 10 units, you don't get the first 6 for free. You have to pay 10 development charges. So they still create these unfortunate sort of like disincentives to sort of build slightly more, but it's a step in the right direction, I'll say. And that's a very recent policy change that City Council just voted on about 2 weeks ago. And what we're hearing now, both from the province and the federal government, is that we think there's a very high likelihood that we'll see across the board development charge reductions in the coming year, whether that's funded through the federal government just writing a check to the city or the provincial government writing a check to the city or something else. But that'll probably be a pretty significant driver of projects that are marginally unprofitable today coming off the sidelines, because that makes a big difference. The other big tax on development is the HST, both the federal and provincial portion of the HST. And historically, when you buy a new condo or a new house in a subdivision, you're paying HST on the purchase of that product, which is not the case when you're buying a resale home. But when it's a new home, you're paying HST on that product. And similarly, when a developer would build a rental building, even whether they sold the building or not at completion, they would have to effectively estimate the market value of the building and then write an HST check to the CRA, which say you just finished building a $10 million 12 unit small apartment building or something like that. Maybe it'd be more like 15 units, whatever it is. You have to write a $1.3 million check to the CRA, 13% of $10 million as your HST sort of payment on the completion of that building. That policy changed over the last year, where both the federal and provincial governments created an exemption effectively for purpose-built rental buildings to effectively be able to like clear that HST obligation, which is, again, a very significant disincentive to development. And then most recently, the federal government has been talking about this policy to allow first-time home buyers to be exempt from GST on their first-time home purchases. So you're starting to see these taxes get stripped away because I think governments are realizing, most estimates show that across the country, and I think this is definitely holds true in Toronto, in the costs of building new housing, over 30% of those costs are attributed back to taxes and fees levied by some level of government, right? So if 30% of the cost to build a new home is taxes, it's no wonder that housing has gotten so expensive in this country. So we're starting to see movement on those.
Yeah, no, it's true. And the one thing I'd like to clarify for any of our listeners, because we're jumping back and forth between for sale product and rental product. So when you're talking about first time buyers that are buying a property, that's for sale product that is being built inside a condo building. Versus when we're talking about missing middle, is mostly focused on rental product. And you also talked about like your example of a $10 million multiplex, that's a rental product that you're getting an exemption on. Can you talk a little bit more about how, like, you touched on it a little bit as you're talking through, but it wasn't explicit. What's the difference between a for sale product like a condo product versus a rental product, and if there is a distinction in the missing middle for these products?
I wouldn't say there's a distinction in the missing middle in the sense that, like, in theory, you can build a fourplex for rent or you can build a fourplex for sale, right? Like, we have a friend who, there's a group in Toronto called Blue Lion Developments, and Blue Lion is building condominiumized multiplexes. So they're building 4 units, 6 units, and they're condominiumizing them and selling individual units the way you would buy a condominium in a 40-story tower. It's complex because the cost to condominiumize is quite expensive and the legal overhead, but it's theoretically possible. So when we're talking about missing middle, we're generally talking about the size of the development, the tenure of the development, whether it's rental or for sale. I think we're seeing more and more people focus on rental because the for sale market has been hit so hard and because there's been new government-led incentives to build rental. Those incentives, as we just talked about, have been heavily on the tax side, but also on the financing side. CMHC plays a heavy role and historically has played a very significant role in the guarantee market on residential mortgages. A lot of people think of CMHC as being the reason they can get a 5% down payment instead of a 20% down payment when they buy a house. But CMHC also rolled out programs over the last few years to encourage developers to build rental. And those programs look like guarantees on construction financing and long-term mortgages on multifamily buildings. When you build a 40-unit building, you as the owner of that building is still taking on a mortgage. It's just a significantly larger mortgage. And CMHC is now in the business of guaranteeing those mortgages, which means you can get longer amortization periods and lower rates effectively. The major difference is you're just seeing that the math used to favor condo and for sale subdivision homes, right? It used to be that every pro forma always looked better as a condo versus a rental. And part of that is because the condo market was hot. And part of that was that there was disincentives to build rental in policy, right? And now that's sort of been reversed where the condo market is not hot and those disincentives are being stripped away and they're actually being replaced with incentives, right? So you run a pro forma on whether it's a multiplex or a 40-story tower, you're just seeing more often now that rental is starting to squeak out as a slightly better outcome than condo or for sale, let's say. And most high-rise projects are just not working at all in either format. But if they are working, they're a lot more likely to be working as a rental product today than as a condo product. That, I think, has been a very direct result of policy changes from multiple levels of government.
So, how much of an impact do these government programs have on this? Like the low cost financing obviously makes a big difference in when you're doing a pro forma. What happens if, let's say, those programs disappear? Are we going to see a decline in number of new housing that is being built that is rental stock? Do you think that we're going to start seeing more for sale product coming back into the market? What are your thoughts on those?
Yeah, I think that's always a risk with these policies is that if you rely too heavily on policy and policy changes, then your strategy needs to sort of adjust along with it. That said, once you lock in that financing on an existing development, that financing is guaranteed for the life of that mortgage, let's say. The CMHC can't rip away a mortgage they've already guaranteed for you, but they can stop issuing new ones, right? So on an existing project, I'd say the risk is minimal. On a strategy that relies on this for every new project, then you always wonder, like, if the policy changes, does my pro forma start to look less attractive? And we've seen this. I mean, CMHC, there's lots of rules around how they qualify buildings for these financing guarantees. And they've changed those rules in real time over the last 2 years, right? They used to have a set of criteria to say, hey, the building has to meet these metrics. Some of these metrics had to do with energy efficiency, had to do with like accessibility for handicapped folks. Some of them had to do with affordable rents. And the way they sort of evaluated these criteria, decide overnight to change the criteria. And then a project that might have worked in the older rules no longer worked in the new rules, right? So that's always a risk. I'll say one of the bigger risks when I look at the rental market is that right now, since 2018, in fact, we've eliminated in the province of Ontario rent control on new buildings, right? So any building completed after 2018 is no longer rent controlled. I don't want to go too far down that rabbit hole because we could probably spend an hour just on that. But there's always a risk that rent control comes back, right? A change of government can change that type of policy. And then as a long-term landlord, you are stuck with whatever that change of policy is. You might have projected that your rents were going to go up 3% a year, but all of a sudden a rent control policy comes in and says, hey, you can't increase them by more than 1.8% or something. That changes the long-term value of the asset that you're holding. Definitely risks there, but right now it feels like, there's a general understanding that if not rental, then there's nothing getting built in Toronto or in Canada. And I say that in broad strokes. Obviously, there's marginal projects here and there that are always getting built, but like at the scale that we need to address the lack of housing supply, I think the government is very sensitive to this right now. We see this as like the right strategy for the next 5 years. It's hard to say after that, is this still the right strategy or not? Because we just can't predict what will happen on the policy side.
No, it's interesting you pointed out to the exemption because Kathleen Wynne was taking over for Dalton McGuinty and she came along and she just kiboshed the whole exemption, and we saw a whole bunch of projects getting canceled. And then Doug came in and he brought the exemption back, but he moved the date from, I believe before it was like 20, I can't remember on top of my head what the old date was, but it actually moved forward by almost a decade. And a lot of projects that were exempt before got rolled into the non-exemption, so they were rent controlled now. So just for the viewers and listeners, so there's a couple of different programs that are available by CMHC. So you have the RCFI program and the MLI program. The MLI Select program also is available for existing apartment buildings. And then you have the traditional CMHC, a conventional insured product where they offer you insurance on or default insurance for anybody that is looking to get a mortgage. Matt, can you speak a little bit about which programs you guys are taking a look at? Are you more focused on the RCFI or are you looking at the MLI program?
When our RCFI recently got rebranded ACLP, Apartment Construction Loan Program, I think it used to be called the Rental Construction Financing Insurance or something like that, RCFI, but same program. So ACLP, we've looked at. I think it's more geared towards larger scale and non-Toronto based developments. I mean, RCFI or ACLP is a lot more politicized in the sense that they have an allocation of funds that they want to geographically and fairly distribute across the country. So they're often a little bit hesitant to put too many of those dollars into the same neighborhood in the same city for the same scale of housing. So you'll see a lot of developers that are getting access to this are building either in the suburbs or secondary markets outside of Toronto. It could be Winnipeg, could be Edmonton, could be places like that. And often there's a degree of like lobbying and political connection that is helpful on the ACLP program to get sort of prioritized to the top of the list. Not an objective set of criteria. You apply, you have to meet certain criteria, but then there's a subjective evaluation as to whether or not you qualify. We rely on MLI Select. MLI Select is a lot more objective. If you meet the criteria, you are approved, and there's no subjectivity beyond that. Naturally, the underwriter at CMHC has to agree that you've met the criteria, so they can nitpick on the criteria with you, but it's a little bit more predictable. What we're finding is some developers are going in for ACLP or RCFI, and as their fallback, they know that they can fall into the MLI Select program. ACLP, the big advantage is that effectively what you're getting is a loan from the federal government at very, very, very low rates. MLI Select is not a loan from the federal government, it's a guarantee from the federal government, but the loan is coming from the private sector, right? So it's coming from a private lender. And so the rates are a little bit higher. They're still cheaper than conventionally priced construction loans and long-term mortgages. But it's almost like ACLP is the cheapest financing you can get, then MLI Select, then you go to the market for a standard mortgage or a standard construction loan. In the process of going for that cheap financing on something like RCFI, there's a lot you need to give up to meet their criteria. A huge percentage of below market rents. It's a huge expectation on things like electric vehicle parking stalls and accessibility standards for certain percentages of your units, like things that I think inherently are not bad things, but they are costly to a project. They just add cost to your pro forma. So it's a trade-off always when you're looking at these things on the pro forma.
Well, talk a little bit about your policy and lobbying efforts. Like, you guys have been making a lot of headway. So I follow you guys on LinkedIn, and we've been watching you since your first Missing Middle conference that you guys had done. And it's every May for any one of our listeners that are interested. Every May, you guys put together a conference where it's open to the general public, and you just have to get a ticket, and you can come and talk to some of the experts in the industry and in the city talking about the missing middle. Tell us a little bit about the conference and your policy and lobbying efforts that you're undertaking.
Yeah, thanks for that. 3 years ago, when we started the Missing Middle Summit, some of these policies were not in the books yet. So it was partially advocacy, and it was partially, there was some early changes that were starting to allow for very small incremental missing middle housing. But at the time, what we realized is that anybody who might build this stuff has never done it before because the policy is so new, right? So nobody had experience building fourplexes or garden suites or laneway suites. It just wasn't something. You had custom home builders and sort of renovation companies, and then you had like high-rise builders. Nobody was building sort of this new product category. And so the original premise was, let's just get people together in a room to trade notes so that as you're going through your project, you can sort of like tell other people what went well, what went wrong. You can ask questions, you can trade contacts, what architect are you using, what civil engineer are you using, things like that. And it sort of grew from there. I mean, last year we maybe had 350 people. Last year, in May of this year, we had maybe 350 people. Most people in the room come from a background of what they're either been doing this now for 2-3 years, they've been building, or they want to get into it. What's nice about missing middle, at least the smaller end of the missing middle scale, is it opens up this whole opportunity for what we like to call citizen development, where average people can become developers. It's just small scale development, right? They might be able to convert their home into a multiplex, or they might be able to buy a little lot with their savings and take this on. But taking it on is, there's complexity in it. There's a lot of opportunities to make mistakes. There's a lot of areas where you're putting your equity at risk. But we've just found that a lot of people have been finding that a passion they want to pursue. And so this has just been a way to like speed people up on the learning curve. It's a one-day event. We just sort of talk through like how to build and how to get financing and, what kind of design considerations and what does the policy allow and not allow. And in the process of doing that, we've had people from the city engage and join us. Brad Bradford's been a big champion as city councilor in Beaches, East York, and mayoral candidate in this coming mayoral's election, but always just been a housing champion. So he comes every year and talks about what is being currently discussed at the city for policy changes. This year, for the first time, we had Toronto Hydro show up. Hydro ends up being a very often overlooked but very important part of a project, like how to service it from a hydro perspective, especially as you get into larger projects where you're just going outside of the capacity of what that street might have in terms of hydro capacity. So you need like upgrade servicing to allow for more density. So there's all these things that people many times learn the hard way because you get surprised with a really expensive bill on something that you weren't contemplating in your pro forma. And the way we see it is the more we can just sort of accelerate people's learning curve, the more projects get built in the city. I think in the process of that, it's become a natural platform for us to talk about the policy changes we'd like to see. We also launched about a year and a half ago a podcast called Hogtown, where we just talk about housing policy for the most part. Often it's us ranting about what annoys us about various levels of government and politicians, but it generally points towards like, hey, intelligent housing reform, things like development charge relief or reductions or deferrals, things like planning permissions, and like non-obvious things. The difference in like meter in height permissions can often make the difference between does a basement unit make sense or not make sense because you can have big enough windows or the windows are too small or something like that, right? Which is, feels very technocratic, but can often be the difference between a project working and a project not working the way it needs to. And what we found over the last 3 years is that although policy was starting to change, what the city was realizing and what we were seeing firsthand is very few projects were getting built because the policy was almost too restrictive. It was in theory allowing fourplexes, let's say, but in practice, the way that they manufactured that policy restricted all the things you might need to make a good fourplex, right? So it just very few building permits got issued over that time frame. And it was so just constantly talking about what were those limiting factors that slight tweaks to the policy could unlock 50% more of these things in the city. So that became sort of the general platform for that. And in the process, we've just gotten to know at the federal level some politicians that were championing housing in the last federal election, at the provincial level, whether within the Ford government or within the opposition parties, there's been a lot of talk about housing. And so often we've just been able to lean in and provide input or influence on people's draft policies as they're putting them together. I will say, like, the last 3 years have been extremely unusual in the sense that housing, for one, just never hit the national discussion. It was never a national scale issue, really, for my entire life. But for the first time, every federal politician needed to talk about housing. Every provincial politician needed to talk about housing, and every municipal politician needed to talk about housing. And it just created the right conditions for change to actually start happening. I think we like to nitpick on mistakes that continue to be made, but if you zoom out, there's been a lot of very positive policy change over the last 3 years. It could be better, it could be faster. There's still room for improvement. But Toronto's policies on this stuff today is unrecognizable from where it was 3 years ago or 5 years ago. So all of that to me is like generally very bullish on like the future of sort of this gentle density product in the city.
Excellent. Maybe we should move ahead right to their portfolio a little bit because we've talked, I think, through some of these slides, Addy. I'm just thinking. Why don't you talk a little bit, Matt, about some of the projects you guys have on the go? Have you completed any in the last little while? Like, what's kind of happening at Toronto Standard?
The ones on the screen are a good snapshot of like the scale of products that we're prioritizing. We have a few on the lower end of this. So our Glencairn project at 14 units. Initially, we thought that would be sort of the smallest project we would undertake. We are now looking at a few like 8 to 12 unit developments. There's been, again, policy change that has made some of this stuff a little bit more viable. But 14 units, this is a 4-story, the one on the right, this is a 4-story walk-up. What's unique about this one is that actually at the 4th floor, typically the building code requires you to kick into an elevator. And so often people just don't build 4-story buildings because of that, because that elevator cost is just too prohibitive. But the way we designed this building is effectively the top 2 floors are stacked units. So you enter the units on the 3rd floor and the bedrooms are up on the 4th floor. They have like internal staircases, and that allows for staircase only access. The other big thing that we spend time on and is very, very directly applicable to this Glencairn project is single or double egress requirements. And egress effectively meaning stairways. When you get to 3 stories in a multifamily dwelling, you need to have 2 means of egress, which generally means 2 interior staircases or 1 interior staircase and 1 sort of like fire escape on the back of the building. On small scale buildings, that stairway requirement is often extremely inefficient from like a layout perspective and can kill a project, right? So in Ontario and Canada are very unique in the sense that we kick into double stairway requirements at the 3rd floor. Most of the developed world kicks into these requirements at the 6th floor, 8th floor, 10th floor, right? So most of the US, most of Western Europe, like what we would consider very developed and mature countries allow for single stairway up to higher levels. And they mitigate, these are fire risk measures, right? They mitigate those things with other things. They put sprinklers into buildings that wouldn't otherwise have sprinklers. They pressurize stairways in buildings that otherwise wouldn't have pressurized stairways, things like that, right? So right now in the city of Toronto, the buildings department is allowing for what they call applications for alternative solutions, which means you can apply to only put 1 staircase into a building that the building code might usually require 2 staircases. And the buildings department will consider that application if you are providing alternative fire safety measures. So in this building, that means we need to sprinkler the building, we need to pressurize the stair shaft, things that we wouldn't have otherwise done. But it allows us effectively to save the floor space of a 2nd stairway in a building that likely wouldn't have made sense if we needed 2 stairways. That's one specifically. This one is 75 meters from the entrance of the Glencairn subway station, which is up the University line. So we're really excited about that. Kipling, and just for context on the planning here, this one is not a rezoning. This is a committee of adjustment set of variances that we're actually going to committee next week on this one to get the variances we need. We'll be able to report back once we do that or don't do that. There's always appeal mechanisms, but the good thing about this project, it's a little bit big compared to the houses next to it, but across the street is an approved 30-story tower. And so in the context of what's being approved in the surrounding area, we feel pretty confident that we'll get this one approved. The middle one, 1006 Kipling, this is the 2 lots I was mentioning on Kipling Avenue that were both 44 feet wide. So currently 2 boarded up houses. This one's going into construction in November, maybe December of this year. This will be one of the first buildings in the city that is built under what's called the Major Streets Policy, and which got caught up in an appeal for quite a while at the Ontario Land Tribunal. We requested to be scoped out of the appeal to continue moving forward with our development. We're now at our site plan approval stage. So our site plan application is in, and we're just sort of waiting for the city to give us back comments. But effectively, this one is it's 6 stories visible. There's a 7th floor, but it's stepped back. It's like a mechanical penthouse, so it's sort of like not visible from the rendering. 46 units, no underground, no parking on site, no what we call type G garbage loading. Garbage loading, for people that live in larger condos, you can picture these like very large industrial sized garbage rooms. Truck needs to be able to drive into the building, lift a bin up over its head and sort of dump it. Those garbage rooms are they take up a lot of space, so they're very inefficient for small buildings. The city created a new policy to allow for the exemption of type G garbage loading up to 60 units. And so that means if your building is under 60 units, you can effectively get away without that size garbage room. We naturally still have a garbage room, it's just much smaller, and it's being permitted under the city's curbside pickup garbage. So in theory, you can roll out bins to the street. In reality, what we'll do here is we'll hire a private garbage service that just has smaller trucks than the city trucks. So that one is going to be our first larger, 46 units is large for us. It's half 1 bedrooms, half 2 bedrooms. We are a 7, maybe 8-minute walk to the Kipling subway station at this property. And obviously leaning into this idea of no parking is newer in the city. We feel pretty confident about it, but it's definitely a newer bet that not a lot of developers are making yet. You'll also notice from that building, and what makes our model sort of viable is it's a very simple building. It's a box. It doesn't have any balconies. It's punch windows. It's Juliet's. And the structure doesn't change all the way up, right? And so that allows us to take on much more efficient methods of construction. If you think of like your historic mid-rises in the city, you'd often find these like wedding cake mid-rises or Mayan pyramids, that step back at every floor. And those were very costly to build because you were effectively changing the structural design on every level of the building. The columns had to shift, et cetera. So these rectangular boxes, as simple as they look, can be up to $100 a square foot cheaper to build because the systems are a lot simpler. Even things like imagining that all of your bathrooms are stacked on top of each other. So your plumbing runs are just straight lines, right? You don't have to sort of zigzag your plumbing as the building design changes on the way up. Those things all add up to pretty meaningful changes, differences in construction costs. The one on the left is on Dufferin. This is between DuPont and Davenport. It's north of the tracks. It's around the corner from Geary Avenue that people might be familiar with, a newer, trendier street in the city. This is a single lot. It's 45 feet wide. It's a very tight build. We're building lot line to lot line. We're getting 59 units. What's unique about this one is it's a deep lot. So if you think most lots in the city are about 120 feet deep, this one is 170 feet deep, and it's got a laneway in the back, which means we're effectively building like 2 sections to the building, one that faces the laneway and one that faces the street, but they're connected in the middle. It's turned into like more of a C shape where the building sort of wraps around an interior courtyard. And the courtyard in the middle allows us to put windows facing into the interior of the lot, as opposed to only having windows front and rear. So sort of allows us to maximize that space. And so that one will probably go into construction. We're just about to submit for our zoning bylaw application. Construction maybe by mid next year or Q3 of next year, give or take. We have a few others not listed here that are in the 3 to 4 story, 8 to 12 units scale. We mentioned earlier, we just hired a construction manager to join our team. Effectively, the way we categorize our projects is if they're 4 stories or under, we will build them ourselves, and we will build them for the most part stick frame, just standard wood structure. If they're above 4 stories, we tend to jump to 6 to 8 stories. We'll work with a third-party sort of mid-rise construction manager that's done larger scale builds. And our CM will build our own stuff, but also will help sort of manage and oversee the third-party CM on these larger projects. There's just more risk. The budgets are a little bit bigger on these bigger projects. But to give you a sense, Kipling is a total project about $23 million from land to construction to financing to design, all in. Dufferin is probably about $26 million, and Glencairn's about 6.5 or so in terms of development costs. And that's sort of the ballpark. I'd say we haven't looked at a project that would be bigger than 30 million. And we won't really look at a project that's smaller than, let's say, 5 million in terms of scale.
So let's dig a little bit deeper. So wood construction, so Kipling and Dufferin, do they actually have elevators?
Yeah, and those are not wood. Wood is Glencairn. Glencairn is going to be wood frame.
Okay.
Kipling and Dufferin are both being built with precast concrete and panelized cold form steel. Precast concrete is effectively the difference between what most construction in Toronto historically would be what we call poured in place concrete, where the concrete's actually getting poured on
Yep.
site and set on site. In this context, the concrete is being cast off site in a manufacturing facility, and what's being sent to us is panels, 30-foot long panels of concrete floors effectively. And then we're just placing them on the building as we build. So almost like a Lego block assembly, but two-dimensional, right? So everything that shows up on site is either a wall or a floor or the wall of an elevator shaft or a stair shaft or something like that. So the floors are concrete, the shafts are concrete, but precast. The walls are cold form steel. Cold form steel, best sort of like visual for people is you see like used very thin gauge cold form steel as like an alternative to 2x4s when you're building like studs for a wall, but there's like higher gauge versions of cold form steel for structural support, and so you can build, and those are also pre-panelized. So the panels, let's say a 30-foot segment of wall is built off site and shipped to site and sort of put pieced together. So that, and Kipling has one elevator, and we'll have two elevators to answer your other question. Dufferin's going up to 8 stories. The picture, the rendering there only shows 7, but it's been updated to 8.
Has any questions?
I think Matt's covered it off pretty well. So thanks for joining us today, Matt, and everybody who's listening or watching online. As far as next steps, feel free to book a call with us at cal.westcliffam.com. Also visit us on our website, www.westcliffam.com. Subscribe to our podcast, and thanks so much for joining us today, Matt. It was a pleasure having you.
That was fun. Thanks, guys.
Okay.
Matt, thank you very much. So if anybody wants to get in touch with you, how can they connect with you? Because obviously you're doing some great things in the city of Toronto. You're being a thorn on the side of government officials that are not listening to the public and to developers and what we need to build and what the end user needs. So how can people connect with you?
Pretty easy to reach. Email Matt, M-A-T-T, at torontostandard.co. And I'm on Twitter often, or X at Matt Spo. That's where I do most of my ranting. But if you want to actually connect with me, probably email's better. But happy to connect with anybody who's interested.
Yeah, thank you guys. And thank you for anybody that joined. Just understand that all the information shared here is for informational purposes only. Please consult with a professional before making any investment decisions. If anybody's looking for copies of the slides, you can send us a text at 647-799-2264 with the word slides, and we can have these sent over to you. You can reach out to us, info@westcliffam.com. If you want to get a video copy of this presentation, you can actually go to westcliffam.com/listen and find us under the webinar section. Thank you very much again, Matt. Thank you, Kaz, for joining. Looking forward to connecting again, and enjoy.
Thanks a lot.